Hello and welcome to this edition of Old Square Tax Chamber's TaxSnax. I'm going to be talking about an introduction to the new changes on the remittance basis of taxation, which is being abolished and replaced with new rules for foreign income and gains. These new rules arise out of the budget on 30th October 2024 and broadly create a fundamental change to the way foreign income and gains are going to be taxed when received by UK resident taxpayers. There will be more detail on a number of aspects of these changes in other TaxSnax episodes concerning commencement and transitional provisions, the new regime for foreign income and gains, new overseas workday relief, temporary repatriation facility, rebasing of assets for capital gains purposes, and inheritance tax on trusts. So this is just an introduction to these episodes. More detail can be found in specific TaxSnax episodes. As matters stand, individuals who are not domiciled in the UK can choose to have income and gains arising abroad taxed only if those income and gains are remitted to the UK. This is quite a favourable basis of taxation, but it's not going to apply to foreign income and gains arising from 2025-26 onwards. So broadly, two issues arise. First, what happens about foreign income and gains before that year that haven't been remitted and have therefore not yet been taxed in the UK? And second, what happens about foreign income and gains that arise in that year or later? First, existing foreign income and gains. They will continue to be charged on the remittance basis. However, what is going to be called the temporary repatriation facility is going to enable an individual who claimed the remittance basis for at least 1 year prior to 25-26 to choose to pay tax at either 12% or 15% on such income and gains, and then be able to bring those income and gains into the UK at any time without further charge. If the individual chooses to pay tax on those income and gains in either 2025 or 26, or in 26-27, the rate is going to be 12%. If in 27-28, the temporary repatriation facility charge rate is going to be 15%, thereafter the opportunity ceases to be available. So if an individual hasn't paid that charge on existing foreign income and gains by 27-28, then those foreign income and gains will simply be charged as and when they're brought into the UK at normal income tax and capital gains tax rates. The choice must be made by what's called a designation and must be made in a return. As I mentioned, income and gains that aren't designated and on which no charge is paid continue to be taxed on the remittance basis. That has consequences for the mixed fund rules. So if, for example, an individual has a bank account that includes foreign income and gains, and only some of the money in that is designated by the individual and therefore charged at the 12 or 15% rate, there has to be rules about working out which part of the money in that account is brought into the UK at any time. Is it the part that's already been charged, or is it the part that hasn't and therefore gives rise to more UK tax on the remittance basis? The rules on mixed funds are being changed so that broadly money that's had the 12 or 15% charge paid on it is deemed to be brought in first. Moreover, that's worked out on an annualised basis, so it's not simply payment by payment, but for ease of administration by reference to the whole transfers in the course of a tax year. Foreign income gains that have already been brought into the UK but have been relieved from UK tax by a claim for business investment relief will continue to be relief from tax. However, those foreign income and gains can be the subject of the TRF charge, and business relief otherwise remains available for foreign income and gains from 2025-26 onwards. Next point, foreign income and gains that do arise from 25-26 onwards, what happens to them? A whole new regime is being introduced. The starting point is that domicile is abolished as a connecting factor for UK taxation. Taxation is going to be based solely on UK residence. Any UK resident individual is taxed on worldwide income and gains, but if a person has been non-UK resident for at least 10 consecutive tax years, then for the first 4 years of UK residence after that, he or she won't be chargeable at all on foreign income and gains. The only income and gains on which the individual will be chargeable are those arising in the UK. So this new regime applies both to individuals who are domiciled in the UK and to individuals who are not. It matters not whether the individual has previously made a claim to be taxed on the remittance basis. Indeed, whether the foreign income and gains are remitted is irrelevant to the exemption. Remittance does not bring them into the UK tax charge. It's also available to individuals whose period of non-UK residence ended before 2025-26. So, for example, if an individual becomes UK resident for the first time in 2023-24, then this regime will be available to the individual both for 2025-26 and 26-27, as those 2 years are within the first 4 years of UK residence. So for an individual like that, it might be worth thinking about postponing realisation of income and gains if possible until 25-26 or a later year. Overseas workday relief is also being replaced. This is a relief that relates to employment income for duties performed abroad. So the new relief will be available for the same individuals as the general foreign income and gains regime. That's to say, anyone who's become UK resident following a period of 10 years at least of non-UK residence. It will be available for the same 4 years after the non-UK residence ceases. So the approach is that all of an individual's employment income is going to be chargeable to UK tax, but a deduction is going to be available for any amount of general earnings or third-party income within the disguised remuneration provisions, or income arising under the employment-related securities provisions, so far as that income is attributable to duties performed outside the UK. Attribution is going to be done generally on a fair and reasonable basis, which in practice means by reference to how many working days the individual has spent outside the UK as a proportion of the total of the individual's working days in the tax year. There's going to be a limit on the amount of overseas workday relief that an individual can claim. The limit is lower of £300,000, and 30% of the individual's employment income for the year for which an overseas workday relief election has been made. Now, this election is a gateway to claiming relief. Once through that gateway, an individual must make an actual claim for relief for any employment income for the year for which the election has been made. This might mean that an individual has to make 2 claims, where, for example, a bonus paid after a tax year is for the tax year of the election. The election will cover the bonus, but another claim has to be made for the later tax year in which the bonus is received. Now, a further particular relief is going to be available in relation to capital gains tax for individuals disposing of assets in 25, 26 or later. So if the individual was not UK domiciled at any time before that tax year, that's 2025-26, and made a claim for the remittance basis for at least one tax year between 2017-18 and 2024-25, then if the asset was held by the individual on 5th April 2017, and from then until the date of the disposal, the individual can claim for the asset's base cost to be its market value as at 5th April 2017. In other words, the individual is rebased, the asset is rebased to 5th April 2017. Similar in concept to previous instances of rebasing, for example, rebasing to 31st March 1982, but obviously with very different conditions. No claim is needed. The relief is automatic, though of course one has to use the rebased asset value in calculating the disposal in one's tax return. It is possible to elect for the treatment not to apply to any particular disposal, so on a disposal by disposal basis, where, for example, the 2017 value might be less than the purchase price. Provisions enable a look-through where shares or securities held on 5th April 2017 have been the subject of a disposal within the share-for-share exchange rules since then. The new asset's base cost can be the market value as at 5th April 2017 of the old asset. Moving then from capital gains tax to inheritance tax, this is also moving to a residence-based regime. Residence is going to be determined by reference to the statutory residence test applicable for income tax and capital gains tax. A new rule is going to be that an individual who has been UK resident for at least 10 out of the 20 tax years immediately preceding the year of the chargeable event, whether that's a lifetime chargeable event or a death, is going to be within the charged IHT on his or her worldwide assets. As for lifetime transfers, whether a lifetime transfer is going to be of excluded property is fixed at the time of the transfer. So in other words, if the property is excluded at the time of the transfer because at that time the individual doesn't meet that residence test of 10 out of the past 20 years, then if the individual later dies at a time when he or she is UK resident, that won't transform the lifetime transfer into a chargeable one. One big change is in relation to trusts. Whether a property in a trust is excluded or not isn't going to be fixed at the date the property is put into the trust. At any time, whether property is excluded or not depends on whether at that time the settlor meets the residence test of 10 out of 20 years. If the settlor doesn't, then the property is excluded property if it's outside the UK. If, however, the settlor is what's going to be known as a long-term UK resident, in other words, has been UK resident for at least 10 out of 20 years, then even property outside the UK within a trust will not be excluded property, regardless of the settlor's residence position at the time the property was put into trust. So that's been a quick summary of some of the very big changes that are going to take place to UK taxation for income tax, capital gains and inheritance tax, where the individual has an overseas connection. As mentioned, there are a number of TaxSnax episodes that consider these changes in much more detail. I recommend them all to you. But of course, however, as always at Old Square Tax Chambers, we're here to help. with what I doubt is going to be some very difficult issues with these provisions as and when they come into practice. Thank you, and bye for now.